Hello, my fellow investors, and welcome back to another fundamental analysis video. Today, guys, we are going to take a look at the company PepsiCo. They did just have earnings, and well, you know what? They're actually falling, and to my surprise, I don't fully understand why. Well, at least I know why, but I think it's just very much uncalled for, because this is a company that, well, I have done here on the channel, and by the way, full disclosure, I do own this company, but I have done it on the channel, and in the past, I have said Coca-Cola actually looks a lot better than Pepsi, but I think after today, after these earnings, well, I think the tides have actually changed a little bit here. Now, they are falling for something that we're going to cover, and it's regarding their overall sales in North America, but if you just take a look at the 5-year perspective, it honestly doesn't even look that bad. So we're going to take a look at this company's, guys, fundamentals, of course, take a quick look at their earnings, and then let's use the discounted free cash flow to see what price we should pay for this company, seeing that it has fallen around 3% at least as of Friday. So with that said, guys, make sure to like, subscribe, comment. It really does help you with the algorithm on YouTube as well as Rumble, and of course, make sure to follow us on X. So with that said, let's get started with this analysis. Now, before we actually get started, I do have to show you guys their products, because Pepsi makes more than just Pepsi Cola, right? They own Frito-Lay's, Mountain Dew, Quaker Oats. So anytime you have anything regarding like Call of Duty promos with Mountain Dew, this is part of that, right? They are essentially being a partnership with that. Quaker Oats, Gatorade, you got, I believe this is Soda Stream. Okay, there you go. Ruffles, you got Eat Path, you got Tostitos, Starbucks Frappuccino, Doritos, etc., etc., etc. So you have a lot of foods, guys, a lot of just overall snacks that they own and that they get their revenues from, not just Pepsi Cola. Now, looking at the biggest news when it came to their earnings is the fact that PepsiCo sales forecast disappoints as North America volumes drop. We get over here, Pepsi Inc. gave a full year sales forecast light of analyst estimates and reported a drop in North America beverages and Quaker Foods units. Sales growth should be at least 4% on an organic basis in 2024. The company said Friday analysts expected 5.2% growth. Pepsi revenue of $27.9 billion in the company's fiscal fourth quarter, missing the average analyst estimate. PepsiCo shares were down 2.3% pre-market trading. And since their earnings were on Friday and we don't have post-market on Friday, this also concluded in the company falling 3.55% intraday to now $167.67 and 0.07 post-market to $167.55. Guys, take a look at this. This is very, very interesting. On the 1 year, this is down 3%. Year to date, they are down 1.28%, 52-week range of 155.83 to 196.88. Now, we did see something similar in regards, we did see something relating to Pepsi, I believe a few months ago, and this was mainly off the fact that 4 months ago, at around October 6th, we got Pepsi stock gets rocked by weight loss drug fears. Earnings could make shares a buy. So yes, this happened 4 months ago where, well, people were very, very scared about the fact that weight loss drugs were essentially going to nuke all of these companies' earnings. In fact, Pepsi alone brought down the entire industry by themselves, which you all can see right here, where as of September 14th, shares were trading at around $181, and then they were just decreasing, but as of October 4th, boom, instant collapse, going from 168.91 to around 158.08. So that's the reason why that caused it. As you guys can see, we pretty much went nowhere ever since then. So with that said, guys, let's now move into their actual earnings. This will be linked in the description below for you guys to read. Obviously, we're not going to go through everything, but I'm just going to go through this very, very briefly. The first thing to note, it is announces annual dividend increase. Yes, they did increase their dividend, and well, they increased it by around 7% to $5.42 per share in annual dividends. Very, very nicely. However, I don't necessarily know if this is going to be affordable, because unfortunately their cash flow in relating to their 5-year average isn't necessarily that good with this kind of increase. Nonetheless, though, this does represent the company's 52nd consecutive annual dividend payment share increase, making them a dividend king. So let's take a look at this. We got net revenue performance. In the fourth quarter, it was down 0.5%, full year up 5.9%, earnings per share of 94 cents for the full year of $6.56, EPS change of 152% in the positive for the quarter. For the year, it is up 2%, and foreign exchange impact on EPS down 2% for both. Now, when it comes to the organic core non-GAAP, we got organic growth revenue of 4.5 for the quarter and 9.5 for the year. Core EPS of $1.78 for the quarter, 762 for the year, and core constant currency of 9% for the quarter and 14% for the year. Let's take a look at what the CEO said. We are pleased with our results for 2023 as we successfully navigated another year of elevated levels of inflation. Wow. Okay, so they're saying the quiet part out loud because, well, inflation is coming down, right? Inflation is coming down, but you guys can see that according to them, no, because at the end of the day, it's not inflation is coming down, it's the inflation rate. Please make that distinction, guys. When anybody tells you inflation is coming down, be like, no, inflation rate. Macroeconomic volatility, geopolitical tensions, and international conflicts. Our results demonstrate that the investments we have made to strengthen our business and advance our PEP Plus agenda are working. It's evident in how we are innovating, operating, empowering our teams by building our brands and competing in the marketplace, said the chairman and CEO. He goes on to say, we are confident that our business will perform well in 2024 in the context of changing marketplace conditions. Now, let's actually take a look at this. For 2024, we now expect to deliver at least 4% organic growth and at least 8% core constant currency EPS growth. We also announced a 7% increase in our annualized dividend, starting with our June 2024 payment, which represents our 52nd consecutive annual increase, and we plan to repurchase approximately $1 billion worth of shares very, very nicely. Now, if we come over here to page 2, we can see the summary fourth quarter performance for 2023 on an itemized region version. However, guys, I want to go all the way down to page number 5, where we're going to see the exact same thing. However, it is for the full year. But I mainly want to take a look at this because this itemizes it where we can actually see their summary for what those charts actually say. So, discussion for 2023 reported divisions results. Frito-Lay's North America operating profit increased 10%. Quaker Foods North America operating profit decline of 9%. PepsiCo beverages in North America decrease of a whopping 52%, primarily reflecting the unfavorable impact of the prior year gain of $3 billion associated with the sale of Tropicana, Naked, and other selected juice brands. Looking at Latin America, we can see that operating profits increased 38%. And when it comes to Europe, we actually got nothing over here, at least on a percent level, because, well, they're just going off of the fact that they are being rocked by the Russia-Ukraine conflict. Africa, Middle East, and South Asia operating profits grew 21%, and Asia Pacific, Australia, New Zealand, and China region, we got operating profits grew 33%. So now let's jump into the calculator. Now, even though the stock is falling a decent amount because of the fact that they missed on analyst estimates when it came to the revenue growth and the fact that they are also losing a decent amount of profit in the America regions, well, actually, the fundamentals got better, believe it or not. We got the ticker for PEP, market cap of $230.5 billion, a PE of 28 points, almost 28 points. Current share price of $167.67. We already took a look at this, so no need to take a look at that any further. They do pay out the dividend of, we just saw it, an increase of $5.42. Now, Seeking Alpha has not updated this, but at the current price, guys, this is a yield of 3.02%. And this is with the previous dividend of $5.06. That dividend yield is absolutely bonkers for a company like this. What's concerning is the payout ratio of 64.31%, a 5-year CAGR of 6.63, 52 consecutive years of dividend payment. We just received this. Ex-dividend date is actually coming up on the 29th of February. So if you guys buy into this company, you will get that dividend paid out on April 1st. Granted, the increase for the 7% is for the June one, not for the April one. So just keep that in mind, and they do pay their dividends quarterly. Now, here's where the problems arise. With this increase of $5.42, based off the current shares outstanding, guys, they pay out $7.45 billion every single year in dividends. Taking the 5-year average free cash flow, subtracting this 7.45, they're left with negative $985.3 million. And for the last year's free cash flow, it is $477 million. So yeah, these payout ratios are very bad. 93.98% and 115.25% for the last year's free cash flow and the 5-year average respectively. Problem is that they increased it knowing this. So what in the world are they doing? They should not be doing this. And on top of that, they also buying back $1 billion worth of shares, which will eventually decrease this payout ratio because of the fact that they don't have to pay out that dividend to themselves. So let's take a look at some fundamentals. We got over here, guys, 5 years ago of $7.3 billion to 1 year ago of $9 billion, not $9.1 billion, increase of 24%. Nice consistent increase, all except for COVID. Not going to nail them too much on that though. I'm going to give this a 95%. The free cash flow looks absolutely incredible. Even though they can't afford the dividend, take a look at this. 5 years ago of $5.42 billion to 1 year ago of $8 billion, increase of 46% with an average of 6.46 billion. They did take a little bit of a hit though from 3 to 2 years ago, probably because of the interest rate hikes. Aside from that, very nice straight line going up. I'm going to give this a 95%. And the revenue looks absolutely incredible too. It is staircasing, meaning that the trend line hits these graphs every single time. 5 years ago of 67.2 billion to 1 year ago of 91.47 billion, increase of 36.2%. I'm going to give this easy 100%. The assets minus the total liabilities looks really good too. Very similar to that of the free cash flow, where consistently increasing all except for 5 years ago. Average total assets being 95.7 billion, average liabilities of 79 billion, a difference of 16.85 billion dollars. This is an easy 95%. Now, unfortunately, the cash flow minus the liabilities isn't doing too good. However, they're not getting too bad either. You can see that, well, they're remaining roughly around the $70 billion mark with an average of negative 68.75 billion. 1 year ago, they're at negative 74 billion. So I'm going to give this a 60%. The shares outstanding came to me as a surprise because they are buying back, but not that much, honestly. And they had one increase, which honestly is perfectly explainable, and it wasn't even that much. 5 years ago of 1.39 billion shares to today of 1.37 billion shares, buyback of 1.22% on the 5 year, and previous year to the current year 0.22. The increase came about from the prior year after COVID, where they increased it by a mere 3 million shares, and then they bought back from 3 to 2 years ago, going from 1.383 billion to 1.377 billion. So this tells me that they increase when they have to increase, which I'm going to give this guys a 95%. And lastly, when it comes into the cash equivalents, they currently hold 9.7 billion with an average of $7.23 billion. Overall grade, this is looking amazing. Again, this is not the overall grade I was giving this thing a few months ago. A 93%, guys, absolutely crazy. Again, wow. The main problem I see with this is the cash flow minus the liabilities, and honestly, the cash flow isn't bad. My main issue with this is the fact that they actually may cut that dividend if they do not increase that cash flow, or at least lower the capital expenditures. Now, if we take a look at this current price, guys, we could see that they have fallen down a lot. They're still down in the 1 year, and even year to date, they're still down. So is this a good time to buy this? The fundamentals look good, but what price do we pay for it? On a normalized basis, not adjusting for debt, we're getting $68.64, and after debt, we got $50.89. Now, for the projected share buyback, guys, I'm going to say, the pity of 1, 2, actually, I'm going to say 0. Let's say 0, then let's say 1, and then let's say 2%, since they are saying that they are going to buy back. Now, for the overall revenue growth assumption, Seeking Alpha is actually telling us that Pepsi is estimated to gain around 5.25%, and the sector median is 4.71. So this is actually very, very easy to do, because all we have to do is just put in for the numbers 4, 5, and 6% for the revenue, and we have the overall price that we should pay here. So if you want to require rate of return, a good price to buy this, not adjusting for debt, $79.06 to $86.44, and adjusting for debt, $61.31 to $68.33. Margin of safety of 5, 10, 15, 52, 12 to $65. Now, a lot of you are going to say this thing would need to fall $100+ for you to even buy it. Well, at the end of the day, guys, every investment is the present value of all future cash flow. And I look at this and I'm like, well, they're not expecting a lot of profits in the future, right? They didn't meet analyst estimates when it came to this. And at the same time, a majority of that cash flow is going to that dividend. So I look at this, and unless they actually increase the cash from operations or lower the capital expenditures or both, I don't foresee this as a good company to buy at 167. I'm sorry, it just isn't. Not from a discounted free cash flow approach. Does this mean that the price will fall to this level? No, it just means that the company should be worth this much in order for you to get a 10% return, assuming that they buy back 2% of shares in the next 5 years and they increase their revenue at around 6%. So I look at this and this is what I'm getting. However, for me, seeing that this is PepsiCo, I would personally start buying at around maybe like the 120 mark. But at the end of the day, investing is an art, and it really just depends up to you. Now, lastly, let's take a look at this dividend because they did increase it. And if we put $5,725, this nets you $185.07 in annual dividends. So all in all, that pretty much does it, guys, for PepsiCo. Again, very, very interesting, right? Because for a long time there, Coca-Cola did have better earnings. Now, Coca-Cola does have earnings this upcoming week, so we'll see how that fares. Nonetheless, though, thank you guys so much for watching. Make sure to like, subscribe, comment. It really does help with the algorithm on YouTube as well as Rumble. Follow us on X. We will be exclusively live streaming on Rumble beginning Wednesday for the next 30 days. If you guys would like to see us there, make sure to stop by there. The link for the Rumble channel is in the description below. So with that said, guys, peace out, and we'll see you all next time.